How to invest $1,000 in stocks. 6 proven strategies for beginners. Before investing larger sums of money for the long term, new investors should learn how to evaluate different investment methods with tiny amounts. The investing world can appear confusing to new investors at first, making the prospect of getting started intimidating. But what if you learn how to invest $1,000 in stocks and scale up from there? The benefit of this technique is that you may fine-tune your investment plan before investing larger sums in the market. The skills you gain from investing $1,000 can then be used to build a long-term strategy that will set you up for decades of successful investment. In this way, you can avoid investing in an unproven plan and losing money, be distracted by the news headlines, or keeping your cash on hand because you don't know what to do. In this video, we'll show you how to invest $1,000 in the stock market using 6 tried and true tactics that others have utilized for years. 1. Invest in ETFs. An exchange-traded fund, ETF, is a collection of securities that tracks the performance of an underlying index. Stocks, bonds, and REITs are examples of common securities contained in an ETF. There are ETFs for stocks, bonds, and REITs. A stock ETF is the Vanguard Total Stock Market Index Fund ETF (VTI). This ETF holds a portfolio of 4,100 stocks trading on the U.S. Stock Exchange. Even if they don't have millions of dollars to acquire shares in thousands of stocks, ETFs allow investors to diversify their investments broadly. Before the ETFs, an investor seeking to diversify their investing portfolio would have to purchase at least one share of numerous companies. For example, if an investor wants to buy one share of each of the FAANG stocks, Facebook, Apple, Amazon, Netflix, and Google, right now, they will require at least $2,787.85 at the time of writing. This indicates that a $1,000 investor will be unable to invest in these 5 companies. Furthermore, a portfolio of 5 firms in the same industry does not provide adequate diversification. ETFs completely altered the scenario. An investor can acquire a share in VTI and have a fraction of a stake in 4,100 different companies with just $20,665. This means that new investors with limited funds might profit from diversification through ETFs. Furthermore, they can benefit from extensive diversification as there are 4,100 equities in diverse industries and market capitalization. VTI. Diversification by sector. You can buy more than 5 shares of VTI for $1,000, giving you a stake in 4,100 firms, or you can buy other ETFs in addition to VTI for even greater diversification. To diversify across asset classes, you could, for example, purchase a bond ETF and a REIT ETF, stocks, bonds, and REITs. You might also buy a stock ETF that includes stocks from markets other than the U.S. Vanguard FTSE Developed Markets ETF (VEA), for example, invests in developed markets other than the United States, and Vanguard FTSE Emerging Markets ETF (VWO) invests in emerging markets worldwide. With $1,000, you could purchase at least 2 of the following stocks: VTI at $206.65, VEA at $45.30, VWO at $41.26, BND Bond ETF $73.48, VNQ REITs ETF $90.64. 2 shares of each of these can provide you with a well-diversified portfolio for only $914.06. 2. Invest in dividend stocks. Dividends and capital appreciation are 2 methods to profit from the stock market. And when learning how to invest $1,000 in stocks, you should prioritize which one. Dividends are payments made to shareholders by corporations as a reward for their ownership. For some investors, the primary purpose of investing is to maximize dividend payouts. This is frequently the desire of retirees or anyone seeking financial independence through passive income. Dividend investing refers to the strategy of maximizing dividends, and dividend stocks are the stocks that these investors prefer. Dividend stocks are simply stocks that pay out monthly dividends. They are generally stocks of well-known and financially reliable corporations such as P&G, Coca-Cola, Johnson & Johnson Lowe's, and Chevron Corp. A good dividend stock not only pays regular dividends, but it is also devoted to raising the dividend it pays to its stockholders. If earning dividends is important to you, you should put $1,000 into dividend stocks. You can achieve this by purchasing a dividend ETF, such as Vanguard Dividend Appreciation ETF VIG, or by using fractional investing to invest in your favorite dividend-paying firms. 3. Invest in growth stocks. Capital appreciation is the second strategy to make money in the stock market. When the price of a stock grows, capital appreciation happens. For example, if you purchased a share for $40 and sold it at $80, you would have made a profit of $40. Growth stocks, as opposed to dividend stocks, strive to increase their share values so that investors can profit from capital appreciation. Rather than distributing dividends to shareholders, some corporations prefer to reinvest profits back into the business in order to boost earnings and, by implication, share prices. Growth stocks are preferred by investors who desire to build wealth over time. These companies are frequently in the introductory or expansion stage of their life cycle, with numerous potential for growth. If capital appreciation is your primary goal, you should put $1,000 into growth stocks. You can achieve this by purchasing a growth stock ETF, such as Vanguard Growth Index Fund, VIGAX, or by investing in your favorite growth stocks utilizing fractional investing. 4. Fractional investing in stocks. Instead of relying on the diversification provided by ETFs, you can create your own diversified portfolio of equities via fractional investing. If you don't have the money or aren't interested in purchasing a full single share, you can buy a fraction of one. In a previous example, we observed that buying a share of all the FANG stocks would cost $2,787.85. However, with fractional investment, you may own all of the FANG stocks for $1,000 by purchasing 0.36 of each stock. This is not limited to FANG stocks. With $1,000, you may build your own stock portfolio by purchasing fractions of a share in all of your favorite firms. Once you've started your portfolio with $1,000, you may quickly transfer cash from local bank accounts, fee-free, to invest $2,000, $10,000, or more, or even set up an automated investing plan. If you have the financial knowledge and time to investigate stocks, this may be a more appealing choice than investing passively in ETFs. Indeed, using fractional investing to build your own portfolio will provide you more freedom and flexibility. 5. Use dollar cost averaging. When discussing stock trading for beginners, one of the most common questions that new investors have is how to get started. The fear of risk can be overwhelming. As a solution to this, financial planners frequently recommend dollar cost averaging, DCA. You can spread out your investment funds over weeks or months using this approach. If you are fearful of investing $1,000 all at once, you can invest $500 every 2 months for the next 2 months, $200 every 5 months for the next 5 months, or $100 every 10 months for the next 10 months. This technique is adaptable and may be used with any of the following tactics, including ETFs, a digital investment platform, fractional investing, dividend, and growth stocks. Aside from removing emotion from investing and assisting you in developing the discipline required for regular investing, DCA can also be a beneficial protective mechanism at the start of or during bad markets. How so? Assume you choose to invest $200 at the end of each month for the next 5 months in a stock now trading at $20 a share. You will receive 10 shares in the first installment. If the stock price falls to $15 in the next month, you will now have 13 shares. If the price reduces in comparison to the previous month, you will receive more shares than if you invested the entire $1,000 at once. However, prices can fluctuate from month to month, resulting in fewer shares than if you put your $1,000 all at once. This is when lump sum investing, the next method, is preferable. Nonetheless, DCA is an excellent alternate method for novice stock traders who are hesitant to enter the market all at once. 6. Use lump sum investing. If you are not the nervous kind who need DCA, investing all at once, lump sum investing is a better alternative. According to a Vanguard research, with a portfolio of 60% equities and 40% bonds, lump sum investing outperformed DCA 67% of the time over 6 months and 92% of the time over a year. Why is lump sum investment better in the long run? It all boils down to the principle of compound interest. When you invest $1,000 right away, it begins earning compound interest. On the other hand, if you simply invest $200 this month, you will only get $200 in compound returns right now. Simply put, the earlier you enter the market, the greater the compound returns, and the greater the quantity with which you enter the market, the greater the compound returns. The longer you invest in the market, the less likely you are to lose money, and the more likely you are to make money. That's all, guys. Thank you for watching. Please leave your opinions in the comments section below. Like, share, and subscribe to our channel for more amazing videos.